Picking the right stock type can make or break your portfolio. Hi, welcome to Squick Invest, Simple, Smart Explainer. If you're new to investing, it's important to understand how different stocks perform during various economic conditions. In this video, I'll explain the three main types of stocks: cyclical, defensive, and growth, so you can choose the right ones to build a resilient portfolio that grows and protects your wealth over time. 1. What are cyclical stocks? Cyclical stocks are companies whose performance closely follows the ups and downs of the economy. When the economy is growing, these stocks usually do well. Think banks, airlines, hotels, and car manufacturers. But during recessions or slowdowns, these stocks often take a big hit because people spend less on travel, cars, or luxury goods. Example, during a recession, airline stocks often drop sharply because fewer people are flying. 2. What are defensive stocks? Defensive stocks are the opposite. These companies sell essential goods and services that people buy regardless of the economy's health. Think grocery stores, healthcare, utilities, and basic consumer goods companies like Sheng or Breadtalk. They tend to be more stable during downturns, but usually don't grow as fast during good economic times. Example, even in a recession, people still buy groceries and medicines, so defensive stocks stay relatively steady. 3. What are growth stocks? Growth stocks are companies expected to grow faster than the overall market. They often reinvest profits to expand rather than paying big dividends. These include many tech companies, innovative startups, or companies in emerging sectors. However, they can be more sensitive to interest rate hikes and economic uncertainty because their valuations depend heavily on future growth expectations. Example, tech giants or electric vehicle makers often fall under growth stocks. 4. How do they perform under different economic conditions? 1. Inflation. Banks cyclical benefit because they can charge higher interest rates. Defensive stocks may struggle if costs rise, while growth stocks often suffer due to higher borrowing costs. 2. Recession. Defensive stocks tend to hold up best. Cyclical stocks usually fall the most, and growth stocks can be volatile. 3. Economic expansion. Cyclical and growth stocks typically outperform as consumer spending and investments increase. 5. Why does this matter? For example, mixing defensive stocks with growth stocks can give you steady income and capital appreciation. Remember, no stock type is perfect on its own. Diversification is key. Start by identifying your risk tolerance and financial goals. Then choose a mix that fits you best. Disclaimer: information in this video is provided for educational purpose only and should not be considered as financial advice. Always do your due diligence or so speak to licensed financial advisor before making investment and finance videos.